Let's talk about a lesser known but incredibly powerful wealth building strategy: currency exchange. Specifically, how to maximize profits through local currency exchange strategies in BRICS countries. Whether you're an investor, entrepreneur, or just someone looking to diversify, understanding currency strategies in emerging markets can give you a serious edge. Let's break down exactly how to make it work for you. Welcome to Brics-reimagined. I am Swazi. So, why focus on BRICS currencies? The BRICS nations, Brazil, Russia, India, China, and South Africa, all have dynamic economies with currencies that fluctuate based on everything from commodity prices to political changes. If you know how to use these fluctuations to your advantage, you can increase your earnings without even changing your job or investments. Imagine earning in Indian rupees, holding it until the exchange rate with the US dollar improves, then converting. Your money literally just grew in value without lifting a finger. Use timing to your advantage. Follow economic cycles and trends. One of the biggest hacks in currency trading is timing. In BRICS countries, currencies can be heavily influenced by economic cycles, so look for key patterns. For example, commodity-heavy economies like Russia and Brazil often see currency spikes when global oil or agricultural prices rise. By holding on to Brazilian reais or Russian rubles during these times, you can potentially cash in when their value is high. Pro tip: keep an eye on key reports like GDP growth rates, inflation, and central bank announcements in each BRICS country. These reports are often available online, and they'll give you insights into when a currency might strengthen. Timing is everything in currency exchange, so the more you know, the more you stand to gain. Diversify across multiple BRICS currencies. Putting all your eggs in one basket is risky, especially in currency exchange. Instead, diversify across BRICS currencies. For example, if you're holding South African rands and you see that the Indian rupee is expected to strengthen, you might transfer some of your rands into rupees. This way, you're not just relying on one currency's performance, but creating a balanced approach that can help hedge against any big swings. By diversifying, you're also gaining access to the strengths of each economy. China's currency might be more stable due to its industrial growth, while Brazil's might see higher short-term gains because of agricultural exports. This strategy spreads your risk and increases your chances of making solid profits across multiple currencies. Leverage digital platforms for low-fee conversions. Currency exchange fees can eat into your profits, so be smart about which platforms you use. Fintech apps like Wise, formerly TransferWise, Revolut, and Payoneer offer lower fees compared to traditional banks. Plus, many of these platforms let you hold money in multiple currencies. This flexibility is gold. It means you can time your exchanges to take advantage of favorable rates without losing money to high transaction fees. And here's the hidden gem. These platforms often offer better rates for currency exchanges than banks do, which can add up to significant savings, especially if you're exchanging large sums. The goal is to minimize what you lose in fees so that more of your money stays in your pocket. Take advantage of currency forward contracts. For those ready to take things to the next level, currency forward contracts are a great way to lock in profits. Here's how it works. Say you're expecting the Indian rupee to increase in value. A forward contract lets you lock in today's exchange rate for a future transaction. So if the rupee does go up, you can buy it later at the cheaper rate you set today, securing a profit. Now, forward contracts are usually for more seasoned investors, but many digital platforms are starting to make them accessible. This is a powerful way to hedge against currency fluctuations and make predictable profits. It's like insurance against market changes while still being able to capitalize on them. Look for arbitrage opportunities between BRICS markets. Currency arbitrage is a strategy where you take advantage of price differences in different markets. For example, you might notice that the Chinese yuan has a slightly different exchange rate in India versus in Brazil. By buying yuan at a lower rate in one country and selling it higher in another, you're pocketing the difference without any major risk. Currency arbitrage can be tricky because you need to watch exchange rates closely and act quickly. But in a high-stakes world like BRICS currency exchange, even a small difference can add up to big profits. Set up notifications or use currency tracking apps to alert you when arbitrage opportunities appear. And lastly, hedge against local inflation by holding foreign currencies. Inflation is a reality in many BRICS countries, but there's a way to hedge against it. When you expect inflation to rise, consider holding some of your funds in a stronger BRICS currency. For instance, if inflation in Brazil is causing the real to lose value, you might convert your reais to Chinese yuan or Indian rupees, which are typically more stable. By holding your assets in currencies that are less affected by inflation, you're preserving the value of your money. This way, even if local inflation erodes the purchasing power of your home currency, your wealth remains relatively unaffected because it's parked in a stronger currency. Currency exchange strategies can feel like a secret, but they're accessible to anyone. By diversifying across BRICS currencies, using low-fee platforms, and timing your exchanges with market trends, you're already setting yourself apart. These tips aren't just for pro investors. They're for anyone looking to leverage the global economy to grow their income.